Welcome to another exciting and educational episode of the Entreprenudist Podcast, the place to hear real entrepreneurs and business owners bear it all. And we're about to do it again. We definitely have an entrepreneur that's going to share some great information for you today. But before we get into it, I want to remind you that this episode is brought to you by Shield Wolf Strongholds, a wealth growth and protection company when it comes to estate planning, when it comes to employee benefits, when it comes to retirement planning, when it comes to life insurance. If your plan ain't Shield Wolf, your plan ain't strong. Visit shieldwolfstrongholds.com to make your retirement better than it would have been prior. Now, who we have on the show? Ian Noble is a seasoned entrepreneur, real estate investor, and founder of Run Steady Investments. After a successful exit of a 14-location service business with 90 plus employees, he built a private network providing investors access to low risk, cash flowing opportunities in passive real estate. The focus is on private lending funds and mobile home parks. He brings 10 plus years of experience as an active real estate investor in Texas and Colorado. He also passively participates in various syndications as a limited partner in mobile home parks, self-storage facilities, private lending, and debt funds. Ian earned his bachelor's degree in economics from the University of Texas. He and his wife, Lauren, live in Austin, Texas, with their 3 children. In his free time, he enjoys marathon running and international travel. Ian Noble, thank you for coming to the Entreprenudist Podcast.
Randolph, thank you for having me. I have to tell you, that is one of the more enthusiastic intros I've ever experienced. And you taught me what Entreprenudist was, because that was going to be a question that I asked right away. Entrepreneurs that bear it all. I got it. I'm wearing
Absolutely,
a shirt,
man.
right? What if I showed up with that?
Hey, I had someone show up with no shirt on. Definitely.
They're like, I thought this was the Entreprenudist Club. You're like, no.
Literally, that's exactly what he did. Hey, I thought this was the Entreprenudist Podcast, right? But yeah, when I started my podcast, I read all the books. I took all the little courses to make sure I followed all the best practices, and I knew that I needed a name that captures people's attention, but then I also needed to explain it, because I said I could just call it the Entreprenudist Podcast, but most people might not get that it's entrepreneur and nudist and we're bearing all. And then I also wanted to still be searchable. So yeah, that's how it came up, the Entreprenudist Podcast. Thank you so much for latching on to the name.
I'm just happy you let me wear my shirt.
Oh yeah, man.
Yeah.
Hey man, this day and age, man, we got to make sure everybody knows this is all optional and consensual. Is there nothing that you know now that you wish you knew when you first started?
Oh, I wish I knew a lot more back then. You learn along the way, and that's what life's about and why entrepreneurship's fun. You end up every day surprising yourself with things that you would take for granted or think couldn't happen, and you learn it all in entrepreneurship. Employees getting flat tires multiple times a week, crazy stories and why something's not working, and it's almost laughable over time, but I'm just happy that I've been in the game for a while and that I love the game of entrepreneurship. So I'm learning every day, something new every day.
And it seems like you're saying that you wish you knew all of the, depending on what angle you're looking at, all of the reasons or excuses that people would come up with along your path.
I wish I knew them, but you still can't prevent them. These things, so my background comes from running a small business. I had a dry cleaners in Austin. And when you have staff, you're going to run into these situations to where, especially in that style industry, where you're scratching your head thinking, what did they say? And it just comes up. Sometimes it ends up on the internet and in the form of a review. We had one time, this is years back, I forgot about this until now, where a gal closed our store early. The hours were 7 to 7. She closed it at 6:58. This was common sometimes when staff wanted to shut down early, and customers let you know. And she, through the glass of the door, told them that our computer systems are on space satellite time and that it was in fact 7:00. And the lady showing her phone, it says 6:58, and our staff did not let her in. Like, this is the kind of stuff that you obviously don't go over that in training. Like, hey, don't lie about the space satellite time that we're supposedly using in our stores. But, you know, luckily I was able to salvage that relationship with the customer and just say, hey, you know, I don't know where that came from, and I'm sorry. That employee was short-lived.
Oh yeah, man. Sometimes people come up with anything and don't take accountability, and it's all about how you say things and do things that determines whether a customer spends with you or continues to spend with you, and how you can recover. Because like I'm sure you've already experienced, you can't control what people do to you, but you can control how you react. And in that moment, you had to choose between one customer, and I don't know how long that employee been with you, but you had to choose between one customer and having to go through the rigmarole of finding somebody to replace this employee. It seems like your methodology is make sure the customers are taken care of. Of course, make sure your employees are taken care of. But if an employee does something that's just almost unforgivable, then go with the side of the customer and find an employee.
You're right. And a lot of times that naturally works itself out. I obviously didn't react and get angry with the employee. But when you start to ask them, why did you do that? What was it for? And you eventually get the answer out of them. They didn't want to keep the store open. They were too busy. They were stressed. So for me, if it's a lie or an excuse like that, usually that person will recognize, all right, the guy I'm working for or with obviously called me out on something I shouldn't have done. This isn't a good fit for me. So it weeds them out to begin with, which is better. You know, you want people to be happy and want to work where they're working, and sometimes it's just not a good fit.
Oh yeah, and I think one of the reasons why people are unhappy is because they're doing something that they don't want to do. And one of the reasons that they're doing something that they don't want to do is because they need revenue. And the only reason they're doing something that they don't want to do in order to get revenue because they need it is because they don't have other streams of revenue. Why do you think most people want more streams of revenue?
You would think that it's about the money, but I do not. I believe that people understand that wherever they're making their money from their main thing, someday that could come to a halt. We're seeing it right now in the tech space. There's massive layoffs. These jobs generally were secure, high-paying jobs. And just like that, it can be taken away from you. You might wake up on a Thursday morning and have an email, thanks for your efforts in this company, but we've closed your department. We don't need you anymore. I think more and more people are seeing the writing on the wall, and there's a push for two things. Number one, ownership and entrepreneurism. You know, find a way to do it yourself. Because if you trust yourself and you put confidence in yourself, there's no better person to, you know, that you're aligned with yourself and you can make something. Now, the other reason is things happen in life. And the more and more that people see this, they'll have a death in their family, or there's a disability or a divorce, whatever it may be. You want to have other streams of income coming in because you can't let life stop. For these people I mentioned with the layoffs, they have a mortgage. Their kids might go to daycare. There's private schools, perhaps. Who knows what their expenses look like? A fancy leased car, all these things that maybe they're going to run into trouble. And the more you set yourself up early and take action early and grow wealth outside of your main business career, the better you're going to be in 10, 15 years to where you have options and the person next to you does not.
Oh, yeah. And the way you said it, you know, somebody might think that in order for Ian to win, the person next to him had to lose. No, when it's done correctly, everybody can win, right? But it's just everybody doesn't seem to be into or have the wherewithal to experience delayed gratification. Is real estate a good way for somebody to get additional income streams?
I love real estate. And if there's an intersection of entrepreneurship and real estate, that's where I land in that zone. Yes, I think it's a great way. And what it affords somebody to do is, from the effort and time that they put into their property, let's take it the easiest level or easiest part of real estate to understand would be buying a single family home. If you put down the minimum and you're able to get a tenant in there and that property can cash flow, then you just make a couple $100s a month. That in itself is not life-changing, and you will not get rich quick. So this is the wrong business for that. But if you continue to do that year after year, and in 10 or 15 years, you look back at the options you have cash flow, you have appreciation, and lots of options that have helped build up your wealth to where if in fact something does happen with your career, you have a fallback and it's something that you own and touch, different than the stock market. So it allows a lot of benefits for people to earn in different, let's say, areas along the way: tax benefits, cash flow, appreciation along the way, and it provides you more access to funds and money later. You can use equity in your properties to go do it again. There aren't many tools out there like real estate, and so that's why I fell in love with it.
What are the tax benefits, would you say, that you've experienced?
Depreciation is the biggest one. Often what that means for those that aren't familiar with it, you can generally depreciate. Let's say if you own a rental home or a single family home, the IRS would generally depreciate that property over 27 and a half years, meaning there are certain components of it that lose value and you get a credit for it. So for example, if you're to look at your tax return, you might see something that says minus $3,000 and it's depreciation. It doesn't mean that you lost $300,000. It's what's called a paper loss. So what's really cool about real estate is in investments, you can do what's called a cost segregation study. And instead of splitting that depreciation up over 27 and a half years, little by little, you can front load it and you can take advantage of the tax benefit that particular year. So to put a number and an example to it, if you have a house worth $100,000 and now there are new laws that were just reenacted called bonus depreciation, you can take almost the full amount of the investment of that property. So let's say $100,000 home, the land is excluded, but the value of the home itself, and you can on your taxes have what's called a paper loss or a depreciation loss of almost equal that same amount. So if you invest $100,000 into something, you might get a piece of paper on your taxes at the end of the year that say minus 80,000, minus 90,000. Depending on your tax situation, you can then use that 80 or 90,000 to offset other passive income that you have. Or if you're what's called a real estate professional, you can offset it against your ordinary income. So we talked about engineers or tech workers. Let's say they have a spouse that's deemed a real estate professional and they make $200,000 a year, and then they go and invest in, let's say, $200,000 into something in passive real estate. If they're married and they have real estate professional status, they can offset the $200,000 against the engineer's salary and effectively make zero on paper. This is in theory, right? There aren't many things that allow for someone to make $200,000 in real life, but make zero on paper and pay less taxes. And real estate is one of those. Oh yeah.
That cost segregation study is a very interesting concept because I've never actually seen a study, but the concept is instead of us just averaging out over 27 and a half years, we're going to take this gypsum board, these floors, these lights, and the life expectancy for this gypsum board or drywall, whatever you call it, might be 15 years, to where we can, like you say, accelerate that depreciation. How much, and definitely is a lot of benefit from being able to segregate these different materials and accelerate the depreciation. How much does somebody typically have to come out of pocket to get one of those studies done?
The larger the property, the more you'll spend, but you can anticipate $2,500. They can go up to much more, $10,000, $15,000, $20,000, depending on how large these structures are. But generally, it's worth it to where if you look at what you could potentially save in taxes, And that's year one a lot of times for people. So you can realize the benefit right away. So you might, let's say you spent $2,500 on a study, but effectively it saved you $20,000 in taxes. You take that all day long. Spend the $2,500 to save the 20 grand that you would have had to pay in taxes. So that formula or strategy repeated over and over again can really help grow and snowball wealth earlier on. And then back to the entrepreneurship side, I think they talked about cash flow not being much in the beginning in real estate. I am a big advocate for people to do both. Make some money outside of your business doing something that can help you build wealth. And if you mentioned earlier, I think you said, let's be clear. He didn't mean that if he gets to take advantage of something, the person next to him does not. And you're right when you said that. But the thing is, many people aren't willing to live beneath their means or to save money because they want to keep up with the Joneses. They want to have a nice BMW SUV that is leased that costs them $1,000 a month, whereas their neighbor might have an older car that's paid off that doesn't cost them that per month. And they are then taking that money saved and putting it to use, giving that dollar a job and making themselves more money. So it feels like you're sacrificing in the short term, and it's because you are, but it's for the longer game when you'll win later on.
Oh, yeah, absolutely. There's definitely ways to look at it. Some people like to say there are two types of people who earn interest and people who pay interest. Actually, there are three types of people who earn interest and people who pay interest, and people who understand you have to pay a little interest to earn a lot of interest. And for some people, that barrier of having to first put out that $2,500 is enough to keep them from winning in the long haul. A marketing professional would say, if every time I spent $1, I got back $2, what's my marketing budget? The answer is my budget is unlimited. If every time I spend out $1, I get back $2, my marketing budget is unlimited. And the same goes when it comes to actually applying knowledge. A lot of people say knowledge is power. No, knowledge is only potential power. Applied knowledge is actual power. And speaking of that applied knowledge, people are going to say, man, Ian just inspired. He inspired me. I'm going to go out and earn income, but there's a difference between earning income passively and actively. What's your opinion on that?
Yeah, you're right. Active and passive are so different. Active income, by definition, is generally something that takes up your time. And time is one of those commodities that's precious because we all have the same amount. It doesn't matter if you're rich or poor, where you come from. We all play on the same clock. Active income means you're spending time, and passive income on the other end is you're pre-allocating money in advance or today to put into something that will effectively help you earn money and buy back your time. Your goal with a finite number of hours in every day is to make sure that you can spend the hours that you want to spend on the things that you like to do. Family, travel, playing basketball, whatever your hobbies are. That's what it's about. And so if you can try to set up ways to earn while, I hate the saying earn money while you sleep because sometimes it sounds cheesy to me. It feels cheesy, but it is true. If you can find out a way to do that.
Who doesn't like cheese?
Yeah, right. And earning money while you sleep.
Yeah.
But, I'll say that it's passive for some, by the way, but it doesn't just mean it happens. So if it's passive for you, it's active for the person that's actually doing it. You're putting your money to work. So someone else is working for you. They're spending their time to gain, let's say in real estate terms, cash flow or to run the property well. You're an owner, but you're not spending your time. And that is passive income. That's freedom. And that's what people generally who I talk to strive to get one day, but it doesn't happen overnight. That is a small incremental change. Same thing with the game of entrepreneurship, doing the little things right over and over again. Eventually it does pay off though.
Oh yeah. And not only does knowing that distinction between active and passive means more time, with family and friends and trying new things. The government makes that distinction too in your money. They've deemed that money that earns money doesn't need Social Security and Medicare, and therefore we're not going to tax you this additional self-employment tax because your money earning money passively. We're not going to tax you as such as a human body earning money actively, because we know eventually you're going to need some Social Security, you're going to need some Medicare. Therefore, we're going to charge you this self-employment tax. So you definitely get that benefit of knowing that distinction. I also noticed that in your bio, you explicitly mentioned that you are a limited partner, and some people might hear the word limited and be like, no. But that dovetails into what you were just talking about. What's the reason that you're so proud of your limited partner status?
Limited partner means you are the passive investor not doing the work. You're letting somebody else do it for you. And so when I had a small business in Austin, I sold that company. And right away after selling, I needed to put my money into something that I thought I would earn from. And real estate, again, was the natural path for me. I'd been buying property back since 2014. 2012, I got my first house, but in terms of investment properties, 2014. I just kept doing that over and over again. So I was so comfortable with it from doing it 10 plus years that when it came time to step away or sell my company, that was the path that I had taken. Now, back to your question on limited partner, it means you are limited in the scope of what you can do. You're giving money to another operator so that they can run the deal. You can use their team and leverage their experience, just like in small business, you would have a team implement task for you. They're doing the same thing. You're putting your money up in advance and they're running the day-to-day. So I'm having a lot of fun with it. You mentioned mobile home parks and private lending earlier. Those are the two lanes that I work with. But after a while, I was doing it for myself and then realized I need to share this with others because many people don't know that it exists. There's a lot of crap on social media telling you that you're going to earn all this money or this return. And I've seen a lot of fads lately that come and go. So my job is to make sure, number one, that I like the investment and that I'm putting my own money into it because I always do. But then once it's safe, in my eyes, there's a low risk and which matches my risk tolerance. That's something then when I can entertain, all right, let's bring this to our group or our network that I've built and let's go do it together as a team. Because it's so much more fun not having to spend your own time dealing with tenants and toilets and headaches and things that come with active real estate investing, which again, is doing it yourself. So I like letting teams do it. And often they're better than you are too, which is great. I thought I was self-managing properties and I had my own way of doing things, but these groups can do things at scale. They have property management teams, staff, they have systems that they've built out that I don't have as an individual. And so I like putting my money in their operation because often you're making more than what you may make if you're doing it actively yourself. And you're saving all the time at the same time. So it's for me, I saw it as a win-win.
Oh yeah, innovation is in the team, and a lot of people do try to go at things on their own, trying to keep 100%, and a lot of times end up getting overwhelmed and end up doing nothing. So the old saying goes, a percentage of something is better than 100% of nothing. And it sounds like you do that when it comes to your deals. Now, some people might consider a disadvantage is, well, if you're a limited partner getting passive income, then you can't write off any losses. Do you consider that to be a disadvantage when it comes to that one asset? Or are there other strategies like the cost segregation study to help offset that, even if you aren't considered a real estate agent?
That's an amazing question. You still get to benefit as a limited partner in the tax advantages, but the way that you can take them is a little bit different. So I'm not a CPA, so I would always suggest check with your tax advisor, et cetera. But if you're an LP and you invest into something, again, I'm going to use a $100,000 example. You're going to get a K1. If it's property based, you'll get they'll hopefully do a cost segregation study. Find this out before you put your money into it, so you know what your benefits of that investment are. If you're a real estate professional, you can take that loss and use it the same year against your other income, whatever you do. If you're not a real estate professional, let's say you've got a veterinarian and a school teacher, and they're married and they invest into a fund as a limited partner. They, by classification, are not real estate professionals. Now, that same $100,000 is going to give them that same paper loss. I'm going to make up a number. Let's say they get minus $80,000. Pretend you have a virtual piggy bank, and over time, if you have other passive income streams that are coming in, you can use that minus 80,000 to offset the earnings that you're getting. Or for the property itself, pretend that it yields, over a couple of years, $80,000 of income. You now have that virtual piggy bank of the loss that you got to offset the income that you're making from that property. So I don't want to use the word tax-free income, but the first chunk of it is, if that's how you would apply it to your situation. So there's a benefit to it that you're not seeing in a lot of other types of investments. And again, I love real estate itself. I say it's simple to understand, but you can touch it. It's run like a business. It's not some pie in the sky. I don't understand how this works, but I'm going to throw my money into it anyway. I'd caution people before they do things like that, because that's where sometimes people get hurt. I think of it as gambling. So invest in something that you understand, or that somebody could understand to you, or a fifth grader or an eighth grader. Like, that's the level that you need to be able to understand before you're comfortable doing something.
Oh yeah. It is the way I look at it is know enough to not get taken advantage of. And the reason why I say know enough to not get taken advantage of instead of know everything on it is because first off, it's impossible to know everything. And what stops most people in life is trying to be perfect before they launch. When a girl is growing up, if her back in the old school, I don't know exactly how old you are, Ian, but growing up, if you were a little girl, what two professions would families say you should marry, either this or this when you get older?
Probably doctor, lawyer.
Exactly. So perception wise, those are considered some of the most prestigious and lucrative, jobs. Now, I happen to know that a lot of home services companies might earn more than the average doctor or the average attorney, but perception wise, that's the most prestigious, right? And even them call what they do practices. They have a medical practice and they have a law practice. They understand that they're practicing at being perfect. And it sounds like you've practiced so much at being perfect that you have a group of people that look to you for deals. How do you find deals for people?
For me, it all starts with finding the right partner to begin with. I'm not running the day-to-day of these operations. And so my job is to align myself with the team that is and utilize their team and skills so that I'm not doing it. Those usually come from networks that I've established or groups or industry trade groups, conferences that I go to. Then I form a relationship with these people. Then I invest in them myself personally. I put my own money in all of these deals. I want to see, are they communicating as they should? Is this deal going as it should, et cetera? And find the best small core group of people that I can then in the future offer our network of investors for them to co-invest with me. Because again, I'm always the first investor. And then they can participate. We can do this as a group and hopefully get equal, well, not equal. We will get equal or better returns than if we go direct to the operator, the person actually doing it. So my job now, when we co-invest in these assets, is to make sure that I am poking holes in these operators or partners, I'll call them, because we end up being partners, poking holes in their underwriting. If you get a pro forma, which is just like a marketing package, right, that says what they think the property will do, I'm then going to look at the underwriting and make sure that it makes sense and that they're conservative in their underwriting and that rent is not jumping up and decreases or dropping to zero. These are the things that you want to look for. I'm background checking these people. I'm flying out to the properties to make sure that everything is legit, because there's a lot of bad people in the industry. So I have found it's very much about trust and knowing who you work with. And especially when you get involved in anything passive, if you don't want that, it's probably not for you. You need to do it yourself and go buy property yourself. But it does take that trust to get involved when you do passive real estate investing, because ultimately it comes down to the people that are working it, not the deal and not the numbers itself, but the human element.
Oh yeah, the human element. And speaking of the human element, you also got to think about perception, right? Just like we were talking about the doctors. I look at you, clean cut guy, strategically placed 5 o'clock shadow at 11 a.m. in the morning, fresh white painting, recessed lighting, some unique
fake pull-up bar.
hey, nice artwork. Hey, no, I'm sorry, aftermarket installed pull-up bar,
right?
Vegetation, live vegetation in the background. I see a guy like you and I think, no way that Ian is investing in mobile home parks. What am I missing?
I get that a lot from people. Mobile home parks are one of those asset classes that have flown under the radar for many years. Many people have a misconception that they are junky trailer parks. Nobody wants to live there. And I would argue that they're not all like that. In fact, every group of, let's say, real estate assets, single family homes, apartment complexes, shopping centers, we all have rundown, what you would view as a rundown property. It doesn't matter what it's in. Mobile home parks are one of those things to where you are giving families the ability to live affordably, where they may not otherwise be able to live a life like that. They can own their own manufactured house, or let's call it a trailer, on that property. So there's some pride of ownership. And often people stay there long term. So we're looking for areas that are pro-growth areas where there are family and communities, and we're getting in there and finding these existing properties we're not developing that are cash flowing already, and then trying to improve the community more, and in turn everybody wins. But yeah, even my own family was asking, what are you doing with mobile home parks? And honestly, there's a lot of flashy things out there, but it fit my character best. I am a low risk guy, and when I see these investments today that are promising huge returns, I hope that for the people that are in them, they get those huge returns. But I know that high returns come with higher risk. And my goal in life now is, look, I'm putting my own money into this first. I don't want to lose my money. I'd rather take a lower return that's still good, may not be great, but I'm eliminating a lot of the risk along the way. And we are in an affordable housing crisis right now. Have been for years. So income is not climbing as fast as housing prices, and we're getting more and more renters. So with mobile home parks, the supply is capped. Unlike apartment complexes where you can build one next door over and over and over, the cities aren't allowing new mobile home park developments to take place. They're very hard to come by. The states don't get as much property tax from them because the homes on them are personal property. That's not real property. Like, it doesn't have a foundation or a slab. So, and neighborhoods don't want them in their backyard because there's a stigma about trailer parks. But at the end of the day, if you provide a good community for people to live in, I think that you're doing good for the residents there. You do good for the investors and the investment itself. And that's what I would value as a good investment to be a part of.
What's the liquidity like in these type of deals? Like, how long, once you're in, how long do you have to stay in?
You think of it like owning a property yourself. If you were to go buy it, because that's generally how they're announced. We'll get something that comes up and then we'll announce it. We're usually raising money for a couple of weeks, and that goes relatively quickly. But then you own that property. And so you shouldn't look at it as a fast liquidity move. Your money might be tied up 3 years to 7 years is just a general rule of thumb. So if you're considering $100,000, but next year you need that for something, it's not the right investment for you. You should put your money into something that's more liquid that you can still earn a return. You forego ownership when you do that, but no big deal. You need to make sure that you're investing in things that fit your lifestyle. And so that's generally, I'd say 3 to 7 years, because I do private lending and mobile home parks, so 2 lanes. One of them has liquidity, which is the private lending. People can pull their money in and out of there and earn a good return. But then on the mobile home park side, they're owning equity, and that's more of a longer term partnership deal. And it just depends on, someone's personal circumstance to which one would be better for them at any given time.
Okay, yeah, because it sounds like the mobile home park is the longer play, but overall, is it a better return than assisting you on the private lending side?
I'd say that the private lending is more fixed, structured. You know exactly what you're going to get all the time. The way that the mobile home parks are structured are a little bit differently. They do give better tax benefits, but it is, generally first year has lower return just because it's a new property, you're fixing things up. So, but over time that can evolve to where you can make better returns. And then there's another strategy that a lot of people are doing that I love right now. And instead of, usually when they show you this investment, they say, we're going to sell it in 5 years and you're going to make 2 times your money. But what a lot of operators are doing, if they find a really good property, they're holding on to it and they're doing a refinance. And so essentially they're cleaning the place up, improving the rents, getting it occupied more than it was. And then they go back to the bank and say, look, our property based on commercial property valuations is worth, let's call it $2 million more. And you take a loan out against the new value and the investors get paid back. So they get a fixed return, they get paid back their money, but since it was a refinance, that money that they're paid back on is a loan, meaning their money, they've been made whole. They're out of the deal financially, but they still own a percentage of the property. They still have equity in it. So that's a really cool strategy. When that happens, you get all your money back. You can go do it again somewhere else. But you still get to participate in the future of cash flow for that specific property. And one day when the property sells, you still get the upside. But by that point, you've already got all your money back from it and you've gone and done it again somewhere else. That's the hamster wheel that ends up benefiting people really well if they take action and start earlier, is you do that over and over again. And next thing you know, you're a part of 5, 10 passive investments. And how cool is it to check your inbox and see you got paid by 10 different operators today? Make money while you sleep.
Oh yeah, we call that mailbox money.
Yeah.
So if you had to put a definition on it, what is private lending and why should people consider it right now?
It's a good alternative to not have your money tied up as long. So if you're not a real estate investor, think of so there's money market accounts that are out there. That's not really private lending, but that pays 4%. And then there's a lot of people that aren't in real estate also are familiar with a CD. That's just, you get a percentage return and it's generally 6 months, a year, whatever your term is. That's what private lending is. You're giving money to a property or an operation or something where there's a need for financing, and in return you're getting a fixed percentage return along the way. So I've seen them at 6%, 8%, 10%. Some of them in the industry are at 15%, and people just need to know the higher you go, the more risk you're taking on. So I mentioned risk tolerance earlier and mine being low. A lot of the stuff I look for isn't the highest return out there. It's because I care more about safety and less about the return. And so it has to fit your appetite with what you're good with, but it's generally lending on something. So for example, we have a fund where it lends to borrowers that are buying property and to do a fix and flip. So we act like the bank. Investors are putting their money in and they get a fixed return, 8, 9, or 10%. We then take that money and lend it out to borrowers at a higher rate. And those borrowers are then buying property, flipping the property, and selling the property. Now for us as the bank, we act like the bank in this scenario. And this happens over about 400 or more homes at once. So it's not like your risk is reduced because it's not going into like the house next door. So then it doesn't matter if the flipper makes 10 grand or loses a couple thousand or makes 100 grand on their flip. You're the bank. So yours is just like this, just like how people pay their mortgage or their rent today, like the number stays the same. And so that's been a cool strategy that I like doing. And, that's more of a short-term thing. I'm seeing people like it better the older they are. I'm seeing people that are younger like to get into equity and have ownership because they have more time on the horizon. But if you're 65 and you're just retiring, or you just, you rolled over your 401k, those are the people that are like, I've accumulated all this money over my lifespan. I have $1 million and now I want to make $100K a year in passive income. That's when you go private lending and you just say, okay, we've got a platform for that. You're going to make 10%. You're going to get paid every single month and you'll make 100 grand. And that's not variable. So it just depends on people's circumstance and what they're looking for. And then hopefully, we try to see if we have something that fits. And if we don't, we say, doesn't work, go find another place.
Oh yeah. I'm just like you. I'm risk averse, but I'm risky. Like it's hard to explain. And when I say I'm risky, meaning I do a lot of things that most people wouldn't do. Entrepreneurship is one of the biggest risks that most people don't do. But I still look at things in a hierarchy of, all right, what's most important to me? A lot of people put that rate of return as number one. But just like you said, sometimes you got to consider the liquidity. You got to consider the safety. You got to consider the rate of return. And you have to consider the tax treatment of how that goes. Because a lot of people don't think about what does it mean to break even when you lose something. And yes, for example, if you have your money directly in the market and it drops 50%. 50% of 100,000 is $50,000. Okay, yeah, oh wow, I just lost 50% of 100,000. I just lost 50%, but then it goes back up 50%. Oh, so I just broke even. No, I'm sorry, it went up 50% of 50,000 now. It dropped 50% and went up 50%. You think you broke even, but really and truly, you're actually down because you have to come back from that loss. And somebody might be saying, all right, I've rode the roller coaster with the 401k it's like doing a yo-yo walking upstairs, but now I'm ready to actually shift over and work with Ian or somebody like him. What advice would you give people who want to learn more?
I'd say start with getting to know somebody who's in the business that can act as your advocate, and you have to like and trust them. That's the biggest thing. Again, I mentioned earlier, passive investing is about trust. And I know that maybe the gurus out there say, no, it's about property and data and what we're going to do and our game plan and how we execute. And I call BS on all that, because you can have a good plan, but if you're not working with good people, it'll never come to be. Same thing with business ideas and why sometimes they never take off. Incredible ideas. It would be a home run. But if the person in charge isn't doing it right, it'll get nowhere. So what I've done for the listeners of this show, we'll include a cheat sheet in the notes of the show that essentially it's a guide on how to get started in passive investing, what questions you should be asking, what I wish I knew 10 years ago. And for anyone who's curious, I'd start there and check that out. The main thing that I would, again, over and over is, if you ever get into a situation to where you're talking to somebody and you're talking investments and you don't feel comfortable with that person, walk away. Doesn't matter what they're telling you or how sweet this deal is going to be. There's more opportunity for you elsewhere. And ultimately it's your money. So you should protect your money as best you can and make sure that you're partnering with the right people, because even when you're a limited partner or an LP, that means you're fully passive. But it's still a partnership. There's still expectations. You need to know every month or every quarter what's going on with that property. These are the expectations, and the cheat sheet will help you kind of see what it looks like behind the scenes before you get going in something.
Mm-hmm. And I think another thing that deserves to be stated, I think as a limited partner, you're also don't have any liability. Is that the case as well? When it comes
generally speaking, yes. If something was to go wrong, or whatever you would look at from a liability standpoint, you're generally removed from it. Versus if you were an active real estate investor and you had a rental and somebody lost their life or whatever, then you're exposed a little bit differently. But as an LP, you're more or less protected. I say more or less. You never guarantee anything in life, but you're in really good shape to not have any concern whatsoever because you're just completely passive and you're not part of the operation.
Absolutely. What's your morning routine?
I get up early and I run. So you mentioned in the beginning, marathon running. When marathon season rolls around, I run 6 days a week or so. So I get up early. And I think a lot of entrepreneurs do this. You're most productive. You got to get your mindset right in the morning. So go do something productive for yourself, whether it doesn't have to be exercise. It could be reading the newspaper, meditating, whatever you do. Just spend some time before you get into the grind and clear your head a little bit.
So you're a runner. Does that mean that your feet look like Old Testament scrolls?
A lot of runners have really nasty feet. I have kept mine in good shape, so maybe that means I don't run enough. But I've seen some nasty feet, and yeah, you have too, evidently. And you're entreprenudist. Put your shoes on, buddy.
Absolutely. What's your definition of success?
Success has changed for me. Obviously, when you're young, people put a dollar amount to something. I think that when you get comfortable in life with your living expenses and you feel a little bit freer, success is all about time and getting to spend the time that you want and doing the things you want when you want. That could be skipping work and going for a walk on a Wednesday, whatever it may be. That is how I define success, because so many people feel trapped, entrepreneurs included. Even with successful businesses, you got to find a way to remove yourself and enjoy the things that you're doing and remember why you're doing them.
Oh yeah, that sounds very close to my definition of success. Options.
There you go.
I don't have to have a Lamborghini to be successful, but I do have to have the option of getting one if I wanted one to be successful. Is there a question that I didn't ask you that I should have?
No, you covered everything. I enjoyed this. This was fun, and I just hope that people listening got some value out of it from today.
No, I'm pretty sure that they did. One more time, please let people know who you are, what do you do, and how they can get in touch.
So my name's on the screen. It's Ian Noble. I have founded runsteadyinvestments.com. We have a private network that I've built where we co-invest into real estate as a group for passive returns. And that happens into private lending funds and mobile home parks. I love entrepreneurship. I like talking to business owners. That was my last 14 years while I was getting into real estate. So I just love meeting new people and talking shop and helping them grow wealth outside their business.
Man, definitely a lot of information shared. Thank you so much. This has been another episode of the Entreprenudist Podcast, the place to hear real entrepreneurs and business owners bear it all. I'm your host, Wendolph Love III. And as always, don't play with it, stay with it until you make pay with it. Make sure to always check our show notes to where you can see a link to where you can get more information on Ian Noble, as well as click the link to see our beautiful ebony and ivory faces live and in the place on the Entreprenudist Podcast. Until next time, signing off.